Our recession signal activated.
Our recession signal is designed to do two things. First, predict when markets are going to start behaving as if a recession is coming. That's already happening. Recession signal did its job there. Second, it's designed to forecast if an economic recession is likely in the next 3 to 6 months.
So tariffs have been getting a lot of the headlines lately, but what about the aspect of the administration that markets were excited about back in November? Tax cuts.
We think the negative economic impact of the tariffs that have been threatened will outweigh the positive impact of tax cuts. There's also a timing issue. Tax cuts, if they go into effect, won't be until 2026. The economy needs help sooner than that.
Hello and welcome to the Outlook by Capstrat. Mike, it certainly has been eventful times in the market. Our recession signal did activate, and so we of course want to talk about what that could mean for our economic outlook. And in the last minute, we'll get into what that could mean for portfolios and opportunities out there in response to that signal being activated. But we'll start with the news that really rocked markets most, the tariff announcements from the Trump administration. Not only much larger than we expected, but also quite surprising in terms of the criteria used.
Yeah.
Well, we went into that thinking that some sort of reciprocal tariff could be favorable for global markets because it allowed a path to de-escalation in negotiation. But the Trump administration announcing that they're going to be using relative trade surplus to assess tariffs on various countries.
Favorable in a sense that not as bad as just a universal tariff, but
Right.
what was announced has elements of the universal tariff that have already gone into place, and then this reciprocal measure, if it's based on our trade deficits, if you were to reduce that, we would have to buy less of other countries' stuff. They would have to buy more of our stuff. That takes much longer to implement. It's much harder to manage.
And so getting into the economic impact or the potential economic impact of these tariffs, a couple of different timelines we're working with, right, in terms of inflation and economic growth impacts.
Yeah, if you take all the tariffs that were announced and you assume they all go into effect, and you also make some reasonable assumptions at this point around additional sectoral tariffs being charged for things like semiconductors, pharma, copper, lumber, things like that. You're getting an all-in increase in the U.S.'s effective tariff rate of about 20 percentage points. And so you price that out in a simple rule of thumb that a lot of economists, market participants are using. For every 1 percentage point increase in the effective tariff rate, you get about a 0.1% shock to core consumer prices and about 0.1% decline in economic growth. So if you were to just look at this very simply without considering other factors, which of course there are a ton of other factors, but you would look at that and say core inflation, one-time increase of about 2%, and real GDP growth, 2% percentage points less than was previously expected. So that's stagflationary.
Right.
That's a stagflationary type of recession. And on the inflation side, in terms of when those prices are going to start hitting consumers, well, we think U.S. companies that are paying these tariffs are going to have to pass them on if they go into effect relatively quickly because of the magnitude.
Right.
Their alternative would be to eat these costs and not pass them on to consumers, but that's just not feasible at these levels. So they're going to have to start passing on these tariff rates to consumers in terms of higher prices, and that's probably going to hit the April, May, and June inflation reports.
Yeah.
So all of Q2 is when you're going to start to see a price shock.
Yeah.
And the economic growth aspect of that's already happening. That's been happening because it's already, even though these tariffs largely have not gone into effect yet, the uncertainty of the policy, which started in February, really, or January. Nobody knows how long these things are going to be around for. Nobody really understands the pathway to de-escalation. If you're trying to make an intelligent, long-term investment decision as a business with regards to your supply chain, there's really nothing you can do, right? Even if you were to shift all your production to the herd in McDonald's Islands, you still don't even get a tariff haven. But you can't make a decision, and that uncertainty weighs on investment, right? So we're seeing that. The other part of that is the financial stress. Financial conditions are much tighter.
Right.
Stocks are down, US dollar is stronger, credit spreads are wider. The uncertainty and the financial conditions in and of themselves are already having a negative impact on economic growth, and if they are left to fester, could potentially create a recession.
Yeah, exactly. That's a perfect segue to our recession signal, but just taking a quick pause here, just looking at the relative levels of uncertainty. I mean, from an economic policy standpoint, you're at levels similar to that of the global pandemic.
Yep.
And then from a trade policy uncertainty index, you could say, oh, well, this is just the Trump playbook. We are significantly higher than the level of trade policy uncertainty in that first term.
Right.
So this is just a completely different situation.
Yep.
And so getting into our recession signal, that's, you know, in our view, the biggest news of the week. The recession signal activates. Mm-hmm. And so the question to us becomes, well, why did that happen? Can we take this at face value? Yep. How should we interpret this? And for the areas that didn't activate, what could happen there? How do we confirm or deny this signal activating?
Exactly, because the point here of the recession signal is twofold. One, predict when markets are going to start behaving as if a recession is imminent. It did its job. That's happening right now. And we'll talk about that more later, particularly in the final minute. And then two, predict if an economic recession is going to happen in roughly 3 to 6 months time period. So let's talk about that part of it specifically. So what triggered? The new trigger was the market stress signal. The S&P 500 down more than 10% from its 52-week high. Investment grade corporate bonds and high yield bond credit spreads, we measure the rate of change.
Right.
So they are widening rapidly right now, very quickly. What we're not measuring are the absolute levels. And that's an important bit of nuance here, because while they are widening rapidly, they're still below levels that you would typically see that would forecast a recession. So that's a bit of a caveat there that we think is important. We would probably have to see credit spreads widen further from here to really feel strongly that this is a true recessionary signal from markets. We're just not quite there yet.
Sure.
And then the copper-gold ratio has been negative for a long time.
That's out there.
So that's the new trigger.
Yeah. Speaking of things that have been active for a long time.
Right. The yield curve signal, which measures inversions of the yield curve, you know, the Treasury yield curve, the smartest economist in the room, it is active. It has been active. In our view, in terms of predicting an economic recession, this one has lost a bit of its fortune-telling powers in this cycle. It's been active since, you know, late 2022, early 2023, and a recession has not transpired. Yeah. And also, what's been announced here with tariffs has absolutely nothing to do with the yield curve. So let's just, for sake of trying to be bullish in some way, shape, or form, let's just take that with a grain of salt and say that one doesn't matter this time around if you're thinking about an economic recession.
Yep.
Then we focus on our other two signals. One of these other two then would have to trigger for us to feel very confident that a recession is coming in the next 3 to 6 months. The first is the real economy signal. We would just need new orders to inventory to fall below 1 when the new PMI data comes out in early May, and then that signal would activate with a 3-month lead. So it would most likely activate in early August.
Yeah.
And the labor market signal, not there yet. We have not even close. We have not seen the type of firing that you would need to see to say, all right, a recession is coming. And this is a coincident indicator. If that triggers, recession's happening. Economic recession is happening. So we're totally not there yet. So when you look at this and you lay it out, you think there's about a 2 to 3 month window here where a recession does not have to happen.
Yeah.
And, you know, what could save the economy in those next 2 to 3 months? Most logically, these things get negotiated down or walked back in some way, shape, or form.
This was the start of the negotiation point. Tariffs not implemented nearly as widely as announced.
Yes. And if that happens now, that would be great, right? If you start to get some positive news flow this week, that could help a lot in terms of potential recession. It could also help markets a lot. We saw a whisper this morning that was ultimately walked back that the tariffs would just be postponed for 90 days, and the S&P 500 and NASDAQ reversed about 6% intraday on the news. So clearly markets are primed for that type of news. If they were to get them soon, that'd be better. But the other part of this is, if we get to the point where the firing starts and businesses that are paying these tariffs are passing them on to consumers, and you start to get that price shock. That is extremely unpopular. I mean, voters do not like, the only thing that they like worse than, that they like less than a recession is a stagflationary recession.
It's tough.
Where people are losing their jobs and prices are going up. So that's where perhaps you could get into the Trump administration's pain point, where you'd say, hey, this isn't working right now. Yeah. We're thinking about a majority at the midterms, where other Republicans outside of Trump are thinking about their careers and re-election possibilities and saying, we have to do something here. This has to be walked back. So there's potential for that as well. The problem is, if you're hopeful on that, there's a bit of the toothpaste can get out of the tube here.
Right.
Once the firing, once the firing starts, it can be very hard to stop.
And so we're, based on our labor market signal, we're still a ways away from that potential pain point, right? So if it becomes, maybe there isn't an incentive to negotiate some of these back from the Trump administration standpoint, where else can the economy or the market look to for help, right? And the place we've become very accustomed to looking to for help is the Fed. Yep. The Fed's going to deliver cuts, right? Is that something that could help stave off this recession, keep us in a good spot economically speaking? So
we think the Fed is far more likely to cut rates in the face of a stagflationary recession, especially one driven by tariffs, than they're leading on right now.
Sure.
And then the market is thinking about right now. So the way we're thinking about it is if we look at the dark blue line on this chart, so it's our core inflationary forecast, and we've worked in our tariff assumptions, and what you see is this is a one-time price shock. There's a hump in the chart, in the year-over-year chart, and then it goes away, and then inflation resumes its trajectory back towards the Fed's 2% target. So this is something they can look through. There's precedent for them looking through it during the first Trump trade war, looking through the inflation in order to focus on the slowdown in economic growth. In order to do that, they would need two things. One, they'd need a reason. The reason is the labor market.
Right.
If you see firing, they are going to come and cut rates. And then two, they need long-term inflation expectations to be stable. And that is true as of now. Long-term inflation expectations have been stable. If anything, they're coming down a little bit. So you put all those things together, we think the Fed is worth about 1.5 percentage points worth of cuts if we get to the point where the firing starts and the toothpaste starts coming out of the tube a little bit. And that can certainly take the edge off.
Yeah.
If you combine that with the fact that even if this recession were to happen, we don't think it would be a severe 2008 style recession because it's self-inflicted, and the price shock is temporary. We think the Fed could put a pretty big dent in that if they're proactive and they come to the rescue. The other thing you have is tax cuts.
Right.
Can we just focus on tax cuts? Are they going to make this all better? Our view is no, that's not the case. The reason for that is the majority of the tax cuts that are being telegraphed right now are extending or making permanent.
Just avoiding a cut, right?
The 2017 tax cuts that are expiring at the end of the year. So that, in essence, is not a fresh tax cut. It's more the avoidance of a tax increase, which has a different effect on the economy, right? It's not necessarily a fiscal boost. And then the last piece is the consumer. So you could look at the chart we're showing up on the screen now and say, hey, the U.S. consumer made it through a prior time period where consumer prices were rising much faster than wages.
Yep.
2021, 2022, and we didn't go into a recession. So why can't we just do it again? And we think it's a much different starting point. A reason why consumers were able to weather that inflationary shock in 2021 and 2022 is they had all these pent-up savings from COVID.
Yeah.
By all accounts, they have largely exhausted those savings at this point, and lower income consumers have completely exhausted them in many instances. The other thing, you look at how tariffs filter through to the economy. Once U.S. companies start passing them on to consumers in terms of higher goods prices, that effectively serves as a consumption tax. And consumption taxes are regressive by nature. Lower income consumers spend a much larger portion of their paycheck month to month, week to week.
Right.
And so therefore they most likely would not be able to weather that storm in our view. So we don't think that's necessarily going to be a saving grace. The only real saving grace here is we're talking about a 2% price shock, which is better than 5-10% price shock or anything like the 1970s oil shock, anything like that.
Sure.
Yep.
Sure. So that's the economic outlook, right? Too soon to call an economic recession. If it were to occur, it would be a self-inflicted stagflationary recession, which is a pretty bad case scenario, right?
Pretty unpopular.
So the question becomes, how are markets thinking about this, or what should we do in our portfolios as a result of some of these developments?
Yep. And so we'll start and we'll revisit our S&P 500 drawdown map. We talked about this during our deep dive on technical corrections. Previously, we were at the start of this, where you look at an S&P 500 drawdown of at least 10%. There have been 28 such occurrences since 1960. We were hopeful that we would retest. That did not happen. Now we have made a definitive move lower, and that brings in a whole different set of probabilities. Once we've had this move lower, the historical probabilities suggest about a 50% chance of going into a recession.
Yep.
36% chance we just stay down here for a while, constantly retesting the lows, which we're still trying to find as we film this video. That could look something like the uncertainty remains. There are some positives on the negotiation front, but largely these tariffs are not getting walked back. The economic data is deteriorating, moving sideways. Fed's trying to save the day. It's just a continuation of this uncertainty, but not getting worse. Mm-hmm. And then finally, the recovery scenario, least likely to happen from here. That would be something like these tariffs start getting negotiated down before they even go into effect, and markets start rallying. That's the lowest probability.
Yeah.
So we look at these historical probabilities and we think, are there any opportunities in markets? Are markets pricing in a greater than 50% chance of a recession? Are there any areas of markets that are particularly have sold off even more than the news flow would suggest?
To your point, there are areas of the market that have now priced in more than a 50% chance of a recession, effectively.
Right. And so one of the first things the recession signal is used for, it's a tool in a portfolio management process to determine when is the market going to start behaving like a recession is imminent. Check, it's happening.
Right.
So then you have to think, as an investor, let's say, for example, you're an investor who came into this very overexposed to equities, very concentrated within U.S. equities. This is very damaging and difficult and probably a very emotional time for your portfolio. Luckily, our clients were not positioned that way. All our clients were underweight global equities, and broadly diversified, which puts us in a little different position because we can look at this and think, can we play this as buyers? Mm-hmm. A lot of the sell-off has likely already happened. And if we start to get any positive news flow, you could see a rally in markets, so that would be a potential buying opportunity. If the economic data defies expectations, the firing doesn't happen, jobless claims come in there real solid week to week, that's a potential as well. And then the other scenario is the sell-off just gets worse, but it gets so bad that we would say overblown, and there are times as a long-term investor you just have to plug your nose and buy because nothing's going on that's great in the world, but it's the best thing long-term. You're buying low.
Valuations get to a point where they're attractive enough that justifies any type of economic scenario.
Exactly.
And that is, of course, something that could happen and has happened in the past, where if we're comparing here just the average S&P 500 return over various time intervals compared to immediately following a 20% drawdown. Yeah. And it's just, as you would expect, the most uncomfortable times to buy are sometimes the most attractive.
Absolutely. First thing, all the time periods are positive. 1 month, 3 months, 6 month, 1 year, 3 year. On average, you get positive returns by owning stocks. So that speaks to being buyers here, potentially, if that makes sense for your portfolio. And then, as you said, after a 20% drawdown, the numbers are even more in your favor, even though it's more uncomfortable. On average, over a 1 year time period, after the S&P 500 has sold off 20%, investors have experienced a 16.7% return. 1 year later, that's about 6% higher than the average 1 year return.
Yeah.
So the risks start to become skewed to the upside.
Yeah.
Yeah.
Keep that idea in mind as we filter through these headlines and the updates on all the tariff negotiations. But that will do it for this edition of the Outlook by Capstrat. If you have any questions or comments, please feel free to reach out.